Just to follow on from what Paul and Dragos have just shown us, just to recap, we start with inherent risk, which is basically the production throughput of an enterprise. And basically, we go to accounting records for sales and trades by product. So we take a product perspective, which is the way accounting works. So it kind of fits in with that. They both talked about the EUF being a measure of operational complexity, which can be just, is it an inherently complex product, for example, or if we're looking at interest rate, a product with long maturity is more complex to handle operationally than a short-term interest rate. So we take all these factors and by product, we come up with an EUF, and then the inherent risk in our use is simply the operational throughput translated into a value band weighting multiplied by the EUF. And that gives, if you like, the risk loading on the enterprise. That's the bogey, that's the risk bogey the enterprise has to cope with on a daily basis. I think in that context, one aspect that is important of all the studies that we've done, going back several years, looking at banking products, operational throughput and all the rest of it, it's clear that as operational throughput increases, the rate at which risk changes decreases, because there is a natural, if you like, a natural increase in operational sophistication that occurs as an enterprise grows, primarily through automation. So if you've got a unit that is predominantly manual, and you ask them to produce a process on a given day, let's say $1 million of additional operational, the chances are they fail if they are manually operating because they couldn't possibly handle $1 million of additional transactions on a given day. If you have, like in the bank I used to work for, handling $2 to $3 trillion, even more on a daily basis, and you ask that operating environment to handle $1 million more transactions, they wouldn't even notice the difference. So we factor in those kinds of impacts into the algorithms that the method generates. So that's the, if you like, that's the first thing, which is the risk loading on the enterprise, which is the inherent RUs. We then look at the...
Sorry, Peter, just like you were saying with Dragos, I think, were you meant to move on a couple slides?
No, I just want to do a quick recap on what we've just seen, because it's relevant to what I'm going to talk about.
Yeah, no, that was really good to explain the difference from it being manual. Sorry about that.
Yeah, so the risk mitigation index is then the risk mitigation effectiveness of the enterprise, and I think you saw the questionnaires. And the big issue there is that we have replaced, typically enterprises use colors to assess risk. We've replaced that with numeric impact weightings in the forms of EUF and numeric scores. And the idea is that you're scoring against industry consensus best practices. So you've got the potential for standardization across industry groups in terms of how these scores. So you've got the basis of comparison that you can make as well, because the assumption is that risk accounting will be a standardized application across industry groupings. So that's the risk mitigation index. And then if you apply one other factor, I think, which is important to mention is you saw the categories people, execution, et cetera, et cetera, et cetera. They map rather neatly into ESG groupings, for example, intellectual capital, human capital. So we can begin to build links between risk accounting and ESG reporting. And then we apply the risk mitigation index against the inherent risk, which gives us the residual risk. And as Paul explained, that's the potential for unexpected loss is your residual RUs. And if you want to improve, if you want to reduce your exposure to residual risk, the first thing you'll try to do is increase or improve your risk mitigation index. So I just wanted to give that quick overview because, like I said, it is relevant to what I'm going to talk about. which is accounting. So in this session, I just want to spend a few minutes talking basically about the approach to valuing the RU as a means to compute expected losses associated with accepted non-financial risks that we can also then account for. And I think a good place to start is credit risk, because credit risk models over time have acquired immensely powerful predictive properties, which is basically what we would also like to achieve with risk accounting. Over decades, modelers have accumulated vast volumes of historic credit data relating to credit defaults and respective borrowers' total credit exposures, and assessed risk ratings at the time of default. At the same time, quantitative modeling and the underlying algorithms have grown in power and sophistication. So the combination of rich sources of historic data and powerful algorithms has created the ability to predict the probability of losses inherent in credit portfolios of all types and sizes with very high degrees of precision. Why won't that? Credit risk models typically use the three labels shown here. And if we have credit risk managers in the audience, they'll be immensely familiar with these three labels: loss given default, or LGD, exposure at default, or EAD, and probability of default, or PD. And if we have sufficient volumes of historic credit data sets with loss, exposure, and risk rating information available to the models, the PD of individual borrowers or whole portfolios can be statistically predicted. But if we turn our attention back to non-financial risk, we discover that the non-financial risk equivalent of credit exposure is typically available as three colors: red, amber, and green, not values. So this begs the question at the bottom of the slide: can classic portfolio management techniques available to financial risks be replicated for non-financial risks? And I guess the answer to that question is presumably an emphatic no, because a prerequisite for a portfolio view of accepted risks is the explicit quantification or valuation of granular exposures and their valid aggregation. And you can't do that with colors. But even though today there's no universally accepted method of quantifying exposures to non-financial risks, there is an expectation that organizations should provide a portfolio view of enterprise risks, which presumably includes all risks, both financial and non-financial. For example, here is an extract from a landmark 2017 COSO paper titled Enterprise Risk Management: Integrating with Strategy and Performance, that talks about risks in execution. First, risks that may impact the achievement of strategy and business objectives need to be identified and assessed. And I put emphasis on assessed. Two, risks are prioritized by severity in the context of risk appetite. Three, the organization then selects risk responses and takes a portfolio view of the amount of risk. And I put emphasis on amount of risk it has assumed. And four, the results of this process are reported to key risk stakeholders. But isn't there a paradox here? In the third bullet, it talks about taking a portfolio view of the amount of risk, which implies quantification or valuation, whereas in the first bullet, it talks about risks being assessed. Amount implies quantification or valuation, whereas assessed implies the application of an appraisal technique that reports outcomes using a non-additive assessment metric, such as red, amber, green, high, medium, low, on a scale of 1 to 10, and so forth. So the bottom line here is that if we want to successfully adapt credit risk models, or their equivalent, for non-financial risks, and enable the application of classic portfolio management techniques, we need a method of quantifying and validly aggregating granular exposures to non-financial risk. And our proposition, the risk accounting proposition, is that residual RUs and risk mitigation indexes constitute that non-financial risk exposure equivalent. I'll use this diagram to explain how that works. There are two sources of input to the risk accounting calculation engine that we've called RiskBox. The first is from accounting interfaces that provide financial data on daily new business booked by product from official accounting records. So the method is tied to official accounting records. Second is the status of risk mitigation vis-a-vis industry consensus best practices. And when we look at risk mitigation status information coming from CSAs, risk and control self-assessments, the E is for enhanced, which means the red, amber, green, typically used in risk and control self-assessments, is replaced by numeric scores and impact weights that can be used in mathematical computations. And as explained by Paul and Dragos, the calculation engine uses three core metrics: inherent RUs, RMIs, and residual RUs, to produce risk reports in multiple categories, including by product, which Dragos just showed us. Operational losses by product are registered in the loss event database from accounting records and other sources. This is already a Basel II requirement for banks. If an operational risk loss is incurred, the product or products involved are identified, and the prevailing residual RUs and RMIs at the time of loss registration are permanently attached to the respective loss in the loss event database. That is the basic improvement that we are creating here, that we attach context information to a loss event. With non-financial equivalents in place, we can begin to mimic credit risk's correlated measurement systems. Through the application of statistical correlation in the center of the slide and backtesting over time, we can derive the monetary value of an RU with increasing precision, which is what we experience with credit risk models. The calculation refinement box on the right is important in this context. When correlated measurement systems are first applied in any risk management process, calculated outputs rely predominantly on subjective inputs and are likely to be inaccurate because of the inherent subjectivity. But as the volume of historic data sets available to statistical correlation grows, correlated measurement systems can progressively displace subjective inputs through algorithms, thereby progressively enhancing modeling precision. And I know that's a subject that Tom, I think, will be focusing on. The design of such modeling techniques and algorithms is an area of deep expertise at the Durham University Business School. The expectation is that the calculation engine shown here will represent fertile ground for the deployment of machine learning and artificial intelligence. And as I said before, with the potential to also link that into ESG reporting. In summary, what we have created here is a second generation advanced measurement approach that we've called AMA2, that has the potential to provide enterprise-wide non-financial risk analytics with multiple aggregation paths, including by customer, product, business component, legal entity, and location. And the great thing is that those aggregation paths already exist in accounting systems. It can also compute expected losses, which could be as simple, and I thought about this very hard and for very long, it could be as simple as multiplying residual RUs by the statistically derived monetary value of an RU. And just for the avoidance of any doubt, I might have created risk accounting and AMA2 are precisely the same thing. It's two names for the same thing. So in conclusion, with risk accounting, also known as AMA2, the much sought after portfolio view of non-financial risks can become a reality. along with the risk adjustment of financial statements through accounting for expected losses. So that's it from me. Thank you very much.